I've got to confess something to you. There was a time I was always broke. Not poor, broke. I was earning money, but my spending was like a leaky bucket. It didn't matter how much I poured in, it kept draining out. Why? Because I was buying things that looked like wealth, new gadgets, luxury dinners, the right car, while secretly chaining myself to a paycheck. Then I made a switch. I stopped asking, what's the next hot investment? And started asking, what would I hold for life? And once I built my never sell list, everything changed. My money started working harder than I was. I stopped panicking when markets dipped, and my focus shifted from lifestyle to legacy. Today, I'll share the 5 assets I'll never sell and why. Miss the last one, and you might waste the next decade chasing short-term wins instead of real wealth. Asset 1, income real estate. Years ago, I bought a humble little rental property. Nothing fancy. 2 bedrooms, a small yard, a neighborhood that wasn't hot, but was steady. The rent covered my mortgage. The tenants were reliable, and every month I pocketed a little extra. Then, one day, someone came knocking with an offer, a big lump sum. The kind that makes you start mentally listing all the things you could do with the money. I convinced myself I was being smart, locking in a profit. So I sold, and for a few months, I did feel smart until I looked back 2 years later. That same property's value had jumped over 40%. The new owner, still collecting rent every single month, cashing in while I was kicking myself. My quick win had cost me years of passive income and a huge capital gain. That moment changed my entire approach to real estate. Now I have one golden rule. I don't sell income-generating real estate unless it's an absolute disaster property. Here's why this mindset has built me steady, compounding wealth. 1. Appreciation is slow but powerful. Real estate isn't a get-rich-quick game. In healthy markets, values often grow 3 or 5% per year, but over 10, 20, or 30 years, that compounds into huge gains. A $200,000 property appreciating at 4% annually could be worth over $430,000 in 20 years, without you lifting a finger. 2. Cash flow is king. Every month, tenants pay rent. That's like having a personal pension that deposits money into your account whether you're working or not. Even better, rents often increase over time, giving you more income without needing to buy more properties. 3. Loan leverage works in your favor. Here's the beauty. While you're holding the property, your tenants are essentially paying down your mortgage for you. Over the years, your ownership percentage grows, and by the time the mortgage is gone, you own the asset outright. 4. Tax advantages are generous. In many countries, real estate investors can deduct property expenses, mortgage interest, and even claim depreciation on paper, which can significantly reduce your taxable income. In some cases, you can sell and roll your profits into another property without paying taxes immediately. 5. Protection against inflation. When the cost of living goes up, so do property values and rents. Real estate is one of the few investments where inflation can actually work for you instead of against you. In 2022, while global stock markets were down almost 20%, my rental properties held steady. A few even increased in value. I call them my sleep well assets because they keep generating income and appreciating quietly in the background. And here's the kicker. In many countries, when you pass property to your heirs, they receive it at the current market value. That means they can sell it without paying huge capital gains taxes on all your appreciation. That's how generational wealth is built, by owning assets that keep paying you in life and keep giving after you're gone. So the next time you're tempted to cash in for a quick win, remember, a one-time profit is nice, but permanent income and long-term appreciation can change your life and your family's future forever. Number 2, shares in strong, established companies. Not the flashy, speculative stuff you see hyped on social media, where everyone's chasing the next big thing and hoping to double their money overnight. I'm talking about global giants whose products you see, use, or consume every single week, and will likely still be around decades from now. These are companies with deep competitive advantages, what Warren Buffett calls a moat. A moat protects a castle, and in the business world, it protects profits. When you think coffee, you think Starbucks, When you think soft drink, you think Coca-Cola. When you make a payment online, chances are Visa or MasterCard is quietly taking a tiny cut in the background. Owning shares in these companies means you're not just a customer. You're a co-owner of a money-making machine. Here's why I almost never sell my stakes in them. 1. Resilience through history. These businesses have weathered world wars, recessions, inflation spikes, political crises, and massive technological shifts, and they're still thriving. Some of them have been paying shareholders for over 50 years without missing a beat. 2. Dividends that grow over time. Many of these companies pay out part of their profits every quarter. I take those dividends and reinvest them to buy more shares, which then generate more dividends. Over time, compounding quietly builds wealth in the background while I sleep. 3. Brand dominance that's hard to beat. Competitors pop up, but household names stick. Coca-Cola spends billions to make sure you reach for their bottle, not a no-name brand. Starbucks has turned coffee into an experience. Visa and MasterCard have networks so massive, replacing them would take decades and trillions in investment. Here's the way I see it. If I own a piece of a company that serves millions of people every day, I'm collecting income from global demand. That's like having a permanent seat at one of the most profitable tables in the world, without having to run the business myself. And here's a little perspective. If you had invested just $1,000 in Coca-Cola in the 1980s and reinvested all your dividends, that single investment could be worth tens of thousands today and still paying you every quarter. That's the power of buying quality and holding on. So when I own shares in a company with a massive moat, global reach, and a proven history of growth, I don't treat it like a quick trade. I treat it like a lifelong partnership, because that's how you build wealth that outlives you. Number 3, broad market index funds. If I could only hand my kids one wealth-building tool for the rest of their lives, it wouldn't be a business, a property, or even a stock tip. It would be this. Index funds are like buying an instant basket of companies. With just one purchase, you own tiny slices of hundreds, even thousands, of businesses across different industries, countries, and sectors. It's like having a global team of companies working for you 24/7. Let me break down why I absolutely love them. 1. Built-in diversification. If one company in the fund has a bad year, it barely dents your portfolio because the other hundreds keep working. You don't need to spend hours worrying about whether Company X will survive a recession. The index fund automatically balances it out for you. 2. Ultra-low costs. Some of the best index funds charge less than 0.05% in annual fees. That's literally pennies for every $100 you invest, which means more of your money stays in your pocket, compounding over time instead of going fund manager salaries. 3. Proven track record. This is the part most people underestimate. Over 10 to 20 years, most broad market index funds beat the majority of professional stock pickers. And they do it without flashy predictions or risky bets. Just steady, market-matching growth. And here's my favorite part. The process couldn't be simpler. I invest a set amount every single month. Rain or shine, good news or bad. This is called dollar cost averaging. And it's like putting your investing on autopilot. No stressing over perfect timing. No staying up late staring at stock charts. No panic selling when headlines scream about market crashes. Now here's a fun and slightly mind-blowing fact. If a 25-year-old invests just $500 a month into a broad market index fund until age 65, assuming the historical average market return of 8% per year, they retire with over $1.5 million. And here's the kicker. Most of that final number isn't money they saved, it's money their investments earned for them while they went about their lives. That's the magic of compounding paired with consistency. It's not gambling. It's not getting lucky. It's patience, discipline, and letting the market's long-term growth do the heavy lifting. So for me, index funds are like the slow cooker of wealth building. You set it, forget it, and years later, you've got something incredibly rewarding waiting for you. Let me ask you something. If you had invested just $1,000 in Amazon back when people thought it was just an online bookstore, would you have sold it, or would you be a millionaire today? The reason I ask is because we're standing at another turning point in history, and this time, the wave is even bigger. Number 4, future-focused industries. I'm talking about sectors that will define the next few decades: artificial intelligence, clean energy, and high-impact biotechnology. Why do I care so much about these? Because every few decades, the world experiences a game-changing leap forward. In the 90s, the internet connected the planet. In the 2000s, smartphones put that power in our pockets. And now, AI and sustainability tech are rewriting what's possible, from how we work to how we power our lives and even how long we live. Here's my strategy and why it works. I never bet my whole portfolio here. That's like putting all your chips on one number at the roulette table. Instead, I treat these as growth accelerators, small, consistent positions that can multiply many times over if I've chosen wisely. And here's the key difference. I'm not chasing hype stocks. I look for profitable companies that are already earning from these technologies, the ones building the infrastructure, supplying the critical tools, or creating the must-have products that the entire industry depends on. Because here's a truth most people miss. In every gold rush, the real fortunes are made by the people selling the shovels, not just those digging for gold. By owning pieces of these industries now, I'm positioning myself to quietly collect the benefits as they scale up without getting caught in the hype-fueled roller coaster. And the best part? While these sectors might create the fastest growth, the next asset on my list builds wealth so predictably that even someone who hates risk can grow rich. Trust me, you'll want to hear this one. Finally, your skills and your reputation. This is a quiet asset. It doesn't show up in a stock chart or on your bank statement, at least not right away. But over time, it's the one that can completely transform your financial life, and it works in any economy. See, every other asset we've talked about depends on outside forces, the market, interest rates, industry cycles. But your skills, your reputation, they're 100% yours. No government, recession, or competitor can take them from you. When I invest in learning how to communicate so clearly that people trust me, how to negotiate deals that others thought were impossible, how to lead a team under pressure, or how to solve problems no one else wants to touch, my income potential expands almost instantly. These are the skills that separate someone who just gets by from someone who commands premium rates, lands the best clients, or gets tapped for opportunities that never even get posted publicly. And then there's your reputation, your trust score in the marketplace. If people know you always deliver value, you'll find doors swinging open without you even knocking. The best jobs, the biggest deals, and the strongest partnerships usually go to people who already have a track record of reliability and results. Here's the beautiful part. Skills and reputation compound. The more you learn, the faster you can learn the next thing. The stronger your name, the easier it becomes to connect with high-level people who can multiply your success. Think about it. Money can be lost, markets can crash, but the right skill set and a rock-solid reputation can rebuild wealth from scratch. When you combine this with the other 4 assets we talked about, you don't just create financial freedom. You create financial resilience, the kind where no single setback can knock you out of the game. Outro, 11:15 to 12 o'clock. B-roll, montage of all 5 assets with text overlays. Voiceover. All right, let's bring it home. Here's your wealth blueprint in 5 moves. Keycap 1 income real estate. Properties that pay you every month, grow in value, and give you tax perks. Keycap 2 shares in established companies. Those rock-solid giants that keep paying dividends and standing tall in storms. Keycap 3 broad market index funds. The effortless way to grow your money long-term without babysitting your investments. Keycap 4 future-focused industries. Smart bets on the innovations shaping the next 2 decades. Keycap 5 your skills and reputation. The asset that works for you in any economy and multiplies every other asset you own. Here's the real secret. Lasting wealth isn't about chasing the hottest trend or timing the market. It's about owning the right assets and holding them long enough for time to turn them into a fortune. So instead of asking, what should I buy next? Start asking, what will I never sell? Now it's your turn. Drop a comment below and tell me, which of these 5 assets do you already own and which one are you starting this year? And if this video gave you that aha moment, do me a favor, hit like, subscribe, and share this with someone who's stuck in the short-term game.